There's a lot of Fed data showing delinquencies rising to pre-COVID levels once again. What does the picture look like moving forward, Scott?
Yeah, that's true. We saw a really benign period post-pandemic where a lot of spending categories went away, right? People weren't eating out, they weren't traveling. There was government stimulus that put more money in people's accounts, and they actually did the right thing. They de-levered, they paid off a lot of that debt. But when the economy opened up and people started spending again, and some would say revenge spending, and inflation kicked in, things went the other way. And there was a real high rate of change in the consumer in 21 and 22, where what you really saw was, as I mentioned, people getting caught off guard. And inflation affects everybody. Unemployment, which is usually a driver of credit card delinquencies, that affects 1 or 2% of the population. Inflation affects everybody. So what we've seen is a real rate of change through 22, but things are stabilizing now and they are normalizing. I wouldn't call credit performance, while delinquencies are up across all categories of credit, they're not up to alarming levels, right? Things have stabilized at a higher level than they were kind of coming out of COVID, but things appear to be normalizing now.
How do you think about your own credit quality here? When people were worried about the state of consumer into a potential recession last year, you did see your stock at LendingClub take a hit. When do you think investors will start to get more excited about the state of the consumer and kind of start to shake off those risks tied to a potential recession and what that could mean for a consumer?
Yeah, you're right. There's been a lot of concern, and I think understandably, about the outlook for the consumer, right? We've been talking about this has been the most forecast recession that hasn't hit, and that's impacted, a lot of, especially consumer finance companies. What we just put out in our last earnings call was we shared our credit data going out over the last 12 quarters. So look back over the past 3 years, showing our delinquency performance. And what you can see is, one, it's stabilized in line with what I just said. And two, our delinquencies are on average about 40% below the competitive set. So we feel really good about the quality of the credit that we're booking. We feel really good about the opportunity in front of us. The fact that there's 1.3 trillion in credit card debt, that is our core market. It's the largest it's ever been. And the spread between the rates that the cards are charging and what we offer has never been larger. So I think, at this point, as the consensus for a soft landing becomes a little higher and, the state of the consumer becomes more clear, we're excited to go after that.